In this video, we're diving into something super important in the world of accounting, the cash flow statement. First off, what is a cash flow statement? Well, the cash flow statement of a business is simply a financial statement that shows how much cash is coming in and going out of a business during a specific period. So why is the cash flow statement such a big deal? Why do accountants, investors, and business owners care about it so much? Here's why. Profit doesn't always mean cash. A business might show a big profit on paper, but still be struggling to pay rent, salaries, and the water bill. That's because profit includes things like credit sales, money you haven't received yet. Many businesses fail because of poor cash flow, not because they are unprofitable. Therefore, the cash flow statement shows the real movement of money. The cash flow is split into three main sections: operating activities, investing activities, and financing activities. Let's look at operating activities. This is the money a business makes and spends doing its everyday work, like selling products and paying bills. Operating activities include receipts from customers, and this is the cash a company gets from people who buy its products or services. There are also payments to suppliers and employees. This is the money the business spends to run its operations. This includes expenses like rent, electric bills, and water bills. Sometimes the business has to pay interest on loans or income tax to the government. Moving on to investing activities. Investing activities show the cash a business spends or receives when it buys or sells items that will be used by the business in the long term. As for financing activities, these are activities that are all about how a business gets money from outside sources and how it pays them back. This includes borrowing of a loan from a bank or issuing of shares. There are two methods used to prepare a cash flow statement. These are the direct method and the indirect method. Method number 1 is the direct method. Here, we show the actual cash inflows and outflows. For example, cash received from customers, cash paid to suppliers, cash paid to employees, cash paid for interest and taxes. This method is very clear and easy to understand because you literally see where the money comes from and where it goes. For the direct method, the operating section is as follows. So we start off with the cash received from customers. Money is coming into the business, so it is added. We then move on to cash paid to suppliers. Money is going out of the business, so it is subtracted. Cash paid to employees is money going out of the business, so it is subtracted. This also applies to interest and tax paid. After adding up all the activities, we get the net cash from operating activities. Method number 2 is the indirect method. This one starts with the net profit and then makes adjustments to arrive at cash from operating activities. For example, you add back non-cash expenses like depreciation, adjust for gains or losses for asset disposals, and take into account changes in working capital like receivables and payables. So here's how to do the operating activities section using the indirect method. We start off with net profit and then add back non-cash expenses such as depreciation. An increase in receivables is subtracted. An increase in payables is added. After adding up everything, we get net cash from operating activities. And that's it for this tutorial.